Okay, so bad news coming out of Bloomberg with the chance of a recession recently hitting 100%. And that's according to their recent report. So it's going to be exceedingly important to navigate accordingly right now. And there are going to be things that you should be doing and things you should not be doing during the recession. In today's video, we're going to be tackling 5 things that you should not do during a recession. So make sure you stick around for this one. In an economic downturn or outright downturn, it's best to keep a tight rein on your spending and avoid taking excessive risks that could put your financial goals in danger. A downturn really could take a toll on your personal finances and set you back for years. I even saw people in the last downturn being set back for over a decade. So being prepared and taking some simple steps to mitigate risk can help you survive the economic turbulence ahead. The first thing you should not do during a recession is become a cosigner. Cosigning on loans can be extremely risky. Even during good economic times, we discourage it. A cosigner may be forced to make payments if the primary borrower doesn't make their required payments. Beyond that, there is a risk to one's credit. But these risks are substantially amplified during a recession. And this is because both the borrower and the cosigner might face heightened probability of losing their jobs or seeing their income from businesses decreased. In order to mitigate risk, we'd recommend you consider other ways of helping a borrower if you are able. One strategy is to be the authorized user. Or allow them to be the authorized user, which is a much better way to help out a friend or a family member. We've discussed authorized user techniques on this channel before. Make sure you check the description below for a detailed video on that. Very popular video, I might add. But it essentially enables you to help boost someone else's credit scores without taking on any unnecessary risk. Now, the second thing that you should not do during this upcoming recession is get yourself into an adjustable rate mortgage. When buying a house, you might decide to go with an ARM or an adjustable rate mortgage, and in some cases the move certainly could make sense. As long as the interest rates are low, your monthly payments will also remain low. Interest rates typically drop in the first few years of the downturn and rise thereafter when the economy is recovering. So this means that the adjustable rate on a loan taken out in the midst of a downturn, it's likely to increase as soon as the recession ends. Now, while interest rates typically drop at the beginning of a recession, lending requirements are usually more stringent, making it difficult for some borrowers to qualify for better rates and better loans. Consider a worst case scenario here. You've lost your job, interest rates increase just as the recession begins to ease, your monthly payments increase, making it exceedingly harder to stay current, late payments and missed payments lower your credit scores, and then it makes it harder to get credit in the future, much less refinance out of that adjustable rate mortgage if you need to. Instead, assuming you have good credit, the downturn could be a great time to lock in lower fixed rates, assuming they come down at some point in the future for a long-term fixed mortgage. However, a typical rule of thumb here is if you can't afford the home under a typical long-term fixed 30-year or 15-year mortgage, it's probably not the right purchase price for you. And if you can't find a home in the purchase price that you're looking for that works for you and your needs under the existing current interest rates, I'm not a believer in the whole date the rate, marry the home concept. Date the rate, marry the home is something I'm seeing all over Facebook. Basically, you have people that are mostly real estate agents promoting the idea that you can always refinance out of this interest rate when the rates come back down. Well, what if they don't come back down and you end up in that loan for the long run? If you can't afford this home comfortably, if it's not something that you can see yourself continuing to make a payment on and being able to do so without it stretching you too thin, in case something ends up drying up within your income, you lose one household income or your income levels come down for any reason, then it's probably not the right home and you should be holding off. You just have to be exercising caution here before taking on any new debt until you see signs that the economy is beginning to recover. Now, a case could be made for getting an adjustable rate mortgage right now, as we're not technically in the recession just yet and mortgage rates are higher. And since rates do typically drop during a recession, it's plausible that you could get it into a better mortgage later on while taking advantage of an ARM right now. But it's completely speculative, and that all depends on each and every deal. It's certainly not the time to be overspending on a property. Make sure that you're only considering an adjustable rate mortgage if it's a great investment deal with low risk. Taking on debt right now could make sense, but it often doesn't during a recession. And that's going to take me to our third thing to avoid during a recession, which is taking on any new debts. Any car loans, home equity loans, student loans, they should not be an issue during good times as long as you're making enough money to make more than your minimum monthly payments while saving for retirement and covering your lifestyle comfortably. But when the economy takes a turn for the worse, and risks rise, including the possibility of being laid off or losing your business revenues, if this happens, you might need to take a job that pays less than your former salary, potentially eating into your ability to repay your debt. So in short, going back to what I was saying, if you're thinking about adding debt to your financial equation, realize that it can make things far more difficult for your finances if you experience lower income. Taking on new debt during a downturn is very risky, and it should be approached with extreme caution. Pay cash when you can, folks, or hold off on major new purchases. That being said, there are massive deals to be made during a recession, and debt can be useful in acquiring some incredible investments for yourself. So be sure to distinguish between what they call good debt and bad debt here. And we typically hate to make the claim that there's such a thing as good debt and bad debt, since all debt we consider bad, and it should be treated as such and treated as dangerous. But there is a big difference between debt that makes you money and debt that takes your money. And we talk about this on a video regarding debt weapons, and make sure to check out that video. I'll put the link in the description for you. Let's move on to the fourth item here, which is that any time during economic downturns, companies large and small may feel a financial pinch, which will make them seek to reduce costs. All too often, this means laying people off. My older brother works for Intel. They're currently laying people off. My younger brother works for Classic Homes. They're currently laying people off. It's coming, folks. And because jobs are so fragile during a recession, workers cannot take finding another job for granted. Older workers who retire in a downturn may see their incomes shrink and their retirement portfolios take a hit, just like the last downturn. And right when they begin drawing it down is the worst possible time for that to happen. We talked often on the channel about the benefits that come from side hustles and replacing your income through investing and business opportunities. And this couldn't be more true during a recession, as it'll benefit you greatly to hedge yourself against any potential hit to your basic streams of income. We feature several different ways to do this at varying levels of risk and activity, so be sure to check the description below. We're going to put a list in there that may or may not help you, give you some ideas to start sifting through, but it's always good to invest in yourself. Just be sure to be smart about it and spend as little as possible until you start to see results. Now, this takes us into the fifth thing that you should not do during a recession, which is make overly risky investments. Like we said, investing in yourself pays, but it can be costly if it's not done right. So take a company or side hustle as an example. While you should always think ahead and how you could grow the company, a down economy might not be the best time to take risky gambles. Early on in the downturn is not a time to put your neck out there on the line. Later, as soon as the economy really starts showing signs of sustainable recovery, is when it's time to start thinking big. Borrowing money to expand your space or adding inventory might seem attractive, particularly because interest rates are likely to be lower in a recession. But if business slows further, you might be unable to pay your payments on time. Each industry is different, so information is key here. Watch for economic indicators that your market or industry have to pick up on before going heavily into something. My drain business, for example, in Colorado. We do drain scoping and hydrojetting. We just started doing some trenchless, no-dig sewer repairs. And we just made a couple significant purchases, including a $63,000 mini excavator. Now, that's going to end up costing the business $2,000 a month through financing. It's 0% interest over 3 years, which is phenomenal, obviously. The money is essentially free. It's nice to have the minimum payments. However, it is tacking on an extra $2,000 a month. We also needed a trailer to tow it. Trailer wasn't cheap. Cost us about $19,000. Financing on that came out to be just right around $500 per month. Now we're at $2,500 a month additional. That's expensive for a small company to handle. However, we're on our first job today, digging with that excavator that we purchased just 10 days ago. And now it's bringing in a $10,000 earnings from just that one dig. We anticipate another 4 or 5 digs that we can do this month, in the month of November, in order for us to actually generate somewhere close to $50,000, which would cover 25 months or 20 months of the actual excavator and trailer's minimum payment obligations. So there are times where you can analyze the risk versus the reward, analyze the demand, the amount of competition, the amount of supply that's there in the area and whether or not your business, service, product, or program can compete with that space. It's very important for you to analyze. It may make sense for you to finance like we recently did, or it might be too dangerous if something were to happen. In our case, because we know people are going to need drain repairs regardless of what the economy is doing, and it will be an essential emergency type of business, it's something that we know we can count on the business still coming in spite of what the economy is doing here domestically. Now, there's really no need to panic in response to economic slowdowns, but you should be especially careful about your spending and really wary about taking on undue risks. Even amid a major economic slowdown, there are plenty of positive steps that you can be taking to improve your circumstances and make sure that you have a recession-proof life. These include adopting a realistic budget. I know that's the dreaded B word. Create extra sources of income, investing in yourself, spending as little as possible until you're seeing results. When it comes to your budget, there's no better tool out there than the Cash Flow Cruncher, which is a complimentary spreadsheet. We give it for free to our viewers here on YouTube at cashflowcruncher.com. You can head over there and get yours right now. Download it. You'll be very glad you did. Everybody that uses it absolutely loves it. Stay tuned for the second part to this video because I want to dive into some of the best things that you should be doing when heading into a recession. I do want to thank you for watching here again today. Make sure you're a subscriber and share this video with somebody who can use it. Until I see you on the next one, make it a great day and keep on cash flowing.